All right, so good evening, everyone. Today we are going to be starting a 5 days Simply Pips strategy splash program. We'll be looking at 4 basic strategies in the course of this week, but it's only natural, especially after the discussion we had in the Telegram group yesterday, that we should look at the psychology of basic trading risk. I'm talking about the risk management. And the reason is that you want to stay long enough for your edge to play out while avoiding the depression that comes with wiping out your equity. We'll be using the same Zoom link for subsequent nights. It will hold starting from today through to Friday. If at any point we feel we can't cover a day's topic, then we might just have a spillover till Saturday or sometime next week. So let's move on. I'll be discussing some statistics with us today. And the statistics has the tendency to make you feel depressed, to make you feel worried, to perhaps discourage you from trading. If I succeed in discouraging you, I wouldn't be happy, but some might not also be sad. And I want you to know here, you stand a better chance of making money buying and selling physical matter than in trading Forex. You stand a better chance buying and selling bags of cement, as in a better chance to success, to making money in buying and selling of perhaps any tangible product of note than you stand to do when you trade the Forex market. However, the possibilities in trading are immense. And the very thought of sitting behind your laptop or perhaps whipping up your phone, drawing some lines on your charts or telling yourself some stories that makes the chart make sense, and then pulling a trigger for a buy or sell to make money is enticing, is interesting. It sells itself to you as a way of freedom. That is actually true. However, statistics shows that over 95% of the people who attempt to make money from trading actually lose money. Above 95% is the data. So it seems like just 5% end up making money. As bleak as that data may sound to you, I want you to have at the back of your mind that this data is not so different from other aspects of life. If you've gone through the 4 walls of a university, you would know that not every lecturer ends up becoming a professor. And not every professor happens to be the VC. If you worked in an organized establishment before, there could be several staffs, few become directors, and even more few will get to the point of becoming a managing director. There are several lawyers, just few will be known nationwide. There are several doctors and surgeons, very few will make landmark treatments that will print their name in the minds of people. There are several indigenes of a particular country. Few will have the opportunity to become president. So as bleak as that data sounds, it isn't actually different from what is observable in other aspects of life. The percentages may vary, however, slightly, 90 or 85% loss. And in that sense, they might be better than trading. But there are several factors that contribute to the bleak success rates in every sphere of life. Some are self-made and some are imputed by other people, or perhaps the system, the environment. Like if you started out to be to own a shop and you are in Ukraine right now, there's a tendency that your shop wouldn't do well. If you start out to be an automobile mechanic or something, and you're in Ukraine right now, or perhaps you started out as somebody who's going to own a bakery, or you own an outdoor restaurant just 2 years back when Corona struck, there's every likelihood that that business would have crumbled, not for any fault of yours. So there are several data and several factors that can affect the profitability of a particular venture. But one thing stands almost true in all spheres of life and whatever venture you go into. Your mind determines how far you can go and how well you will go far. And today we have substituted that word mind with your psychology. For traders, one thing that easily affects our psychology is taking losses or losing the whole of our account. I don't have the data to support the next statement I'm going to make, but I could almost be bold to say that losing an account totally has far-reaching damage to the psychology of any trader, that it might take weeks, if not months or years, to undo them. Because as humans, we are wired in such a way that evil or bad things stick more to our subconscious than good. And you see this happening in your interactions with friends, relations, and acquaintances. Your friend could have been good to you 100 times. He only needs to do one bad, and then you will almost instinctively forget all the good that the person has done and remember the bad continually and bear grudge over that singular act. The same thing that losing an account, totally wiping off your account, does to your psychology. It dents it. And many times, some people never recover from that. I will share a statistic with us from one of the prop firms we usually trade with. Now, this is statistics from a prop firm. Let me see if I can call up my calculator here. So we do some things ourselves. This is one prop firm. I wouldn't mention the name, just so I keep that to myself. But those of you who have been to our fostering program, mentorship program, will know this prop firm very, very well. And I love this prop firm in the sense that they are very, very, very open, very, very open in dissemination of information. In the month of October last year, this prop firm had 3,544 traders who were confident enough that they can make money trading And so they purchased a prop account. In that same month, a total of 1,482,000 was paid out to traders. Very interesting. The most traded pair was gold. The most profitable pair was GBP AUD, and the least profitable pair was GJ. Everything I've just said so far isn't what we're looking for. Now we are going to the main statistics. So let's look at 3,544 new live accounts. 3,544 new live accounts. Here, where my cursor is, only 18% passed phase 1. Only 18% passed phase 1. 18% is times 0.18. So out of that 3,544, only 637 passed phase 1. The remaining people or traders or account holders could not scale through. Now, out of these 673 traders, only 31% of the traders passed phase 2. So again, times 0.31. It takes us down to 197. 197. Look at where we started from. 3,544 traders who had gone through one mentorship class, 3,544 traders who learned how to trade from one mentor, well-known or obscure as the mentor may be, 3,544 traders who had learned one magic strategy and are hoping to trade more funds. Now we've gone through phase 1 and phase 2. It's time for them to trade to eventually start making money. Only 4% of those traders eventually make money. So let's do this calculation, times 0.04. So we started out with 3,544, and we ended with only 8 that were profitable. Now let's do the math. 8 divided by 3,544. Multiply this by 100. It gives you 0.2%. That is a 99.8% failure rate. It seems like the 95% failure rate I mentioned above was initially conservative. 0.2%. 9 out of 3,544 made money. Are you still interested in being a trader? Do you think you could come in without hard work, without structure, and just strolling and make money? Do you believe the Instagram, Forex traders, gurus, and other people online who make you feel all you need to do is get a laptop, sit by a beach side filled with bikini-wearing women, and then you drink champagne and make money? Well, this is real life here, data. Now, let's look at the important notes below. This guy mentioned, the prop firm, that the pass rate was particularly high. I want you to see the choice of words. If they said the pass rate was high, that would have been normal. The pass rate was high. They said particularly high this month because their violation system was missing a large number of violations, not small, large number of violations, particularly high. Meaning, these win rates we are seeing are actually abnormal. And this implies that the win rate in terms of percentage could be far, far lesser than 0.2. Now, if you heard what I said, far, far lesser, after 0.2, how far less can it go? From 0.2%. Now, that is just the month of October. Let's look at the month of November. In the month of November, 5,718 new live accounts were purchased, an increase from the previous month. Let's do our math again. 5,718. Again, only 10% passed phase 1 times 0.1. It brings it down to 571. Past phase 1. 90% failed at month 1. After the first 30 days, 90% went back home with their tails within their legs. Phase 2, 24% passed times 0.24. That brings us to 137. 2 months back-to-back success. Right? That means there were 137 divided by 5718 times 100. It simply means at the end of the second month, only 2 persons or 3 persons, 3% were profitable. Only 3% were able to be profitable month 1, month 2. And by profitability here, I'm using it loosely to mean 8 and 5%. That is 8% in the first month, 5% in the following month. That is what this particular broker adopts, sees as success. You have to have done 8% in the first month, then you have to have done 5% in the following month. Now, the third month, you can do any percent you want. Just make it positive. It could be 0.1%, it could be 1%, it could be 0.01%, whatever it is. Just ensure you are profitable in the third month. Well, only 3% of this 137 managed to be profitable. So let's do that times 0.03. That leaves us with 4 persons. Notice the previous month was October. We had 9 persons out of 3,544. Then the month of November, we had even more persons. That is 5,718 accounts, but the number of winners dropped to just 4 out of 5,718. If we do this math again, divide this sum by 5718 and then multiply by 100. That is 0.1%. 99.9% of the people who attempt to make money trading with this broker lose their money. I want you to consider again, do you really want to trade Forex? Now, let's look at the note behind, below. The note below here, it says for the start of the month. Remember, in the month of October, they had some errors in their violation system. It was some of it we are missing. Those things, spilled over into the early part of the month of November. So for the start of the month, the pass rate was high due to our violation system missing a large number of violations. Now let's look at some takeaways from this broker. Here are some takeaways. There's a difference between myth and data-proven comments. So let's start with one. A trader who holds trades over the weekend has a 60% higher chance of failing or losing the account. And if these guys give this conclusion, we should trust them, because just in 2 months, they've been able to assess a total of 3544 plus 5718 individual accounts. It may not be individual traders. There might be some traders who bought in October and then bought again in November. But they've been able to access, they are gathering this data, at least for the month of October and November alone, from over 9,000 accounts. And they say, when you hold your trade over the weekend, Friday into Monday, you stand a 60% chance of failing or losing your account. They also mentioned that when the market is more volatile, more traders fail. Why? Lack of risk management discipline, which is what we're trying to discuss today. What is this risk management discipline? That's what we'll be covering in the next 20 minutes. As retail traders, we know that we like volatility. We like it when we enter a trade on GJ and in 10 minutes, boom, it has hit our take profit. Then we'll go to social media and share that this is my after and this is my before. I'm a god. We like it when price moves straight, without pullback, straight to our TPs. But the statistic is saying that when the market is volatile, the way we claim we want, more traders fail. Interesting statistics here. And if that volatility is prolonged, it is a bloodbath of epic proportions. Why is it a bloodbath of epic proportions? It's because, from my experience, either of two things. The trader got in at point A, anticipating that price will go to point B, but price eventually went to point C, or went to the direction of point C. Either of two things would have happened, or three things. Number one, the trader had no stop loss, and so the high volatility squandered the account. Or number two, the trader had stop loss, but then when the trade was coming towards his or her stop loss, the trader then deleted the stop loss, hoping that price will make a U-turn, and then had a loss of epic proportions. Or number three, the trader kept adding more trades in the same direction, therefore compounding the loss and making the account wipe out even faster. These brokers say they have only 5 traders who have been paid at least 8 times. If I'm to assume that each payout happens at the end of the month or one calendar month, it means these guys have been getting paid month in, month out for 8 months. There are certain characteristics that these traders have. I want to look at them briefly. Number one, all of them, emphasis on all, trade conservatively. All of them trade conservatively. It means none of them is trying to double their account. None of them is trying to make 50% in one day. None of them is trying to flip the account and therefore have bragging rights. None out of these 8 that has stood the test. If we do a brief statistics here, without really, with the data we have in front of us, we have 3455 plus 5718. If we find a simple average, that gives us an average of about 4,586 accounts, new accounts every month. If we assume that this amount is constant, multiply this by 8, you have 36,692. Out of 36,692, only 5 traders have had payouts back to back for 8 months. I know this math is not correct, in the exact form, but I want to drive home something. Right? Let's divide this amount by 5 and then find the reciprocal. And times 100. This is like 0.1%. And if you're a math student, this can be approximated to 0. It is like saying 100% of that 36,000 cannot claim to be profitable month in, month out for 8 months. Let's continue with our analysis. So they all trade conservatively, and they make sure they get paid. I won't be explaining what that statement means here. Second sentence, none of them risk more than 2% per trading day. Emphasis here on 2%. And I'll be telling you right here how you can determine your percentage. I will tell you today how you can determine your percentage and begin to behave like these guys that are making money. Remember, the first emphasis was all of them, without exception. They all behave in a similar manner. They ensure they don't risk more than 2% per day. And they stop when they have reached about 4 to 8% in profit. Because this broker has a 30 days payment cycle, once they make 4 to 8%, they practically stop trading and ensure they get paid. Next thing, all traders, again, emphasis on all. Emphasis again on all, ladies and gentlemen. Remember, I warned you at the beginning that some of you might not like what I have to say. Unfortunately, you just need to hear the truth so that you could get better in your trading. All traders, all who received record payouts. Record payout means they flipped their account, they did 50%, they did 30% in 1 month, they did some massive things, they were interviewed on YouTube, they went to Instagram and made a lot of noise, they caused confusion in some Telegram groups. All of them who received those record payouts, they lost their accounts within 3 weeks of that record payout. Why? For you to have had a record payout, you just have to be, you would have been excessive with your risk. So it simply means that you were only lucky that your excesses were in the direction of the market. And for every trader that I know, every trader that I have met, every trader that I have met, and I've not met so much, but I've met more than a handful, every trader that I've met stands a chance of losing more than they will win. That's in having losing trades more than they will have winning trades if they trade 10 times. Meaning that if they trade 10 times, most times they will have at least 50-50 or 60% loss and 40% win. But the good ones, even with the 40% win, will make money. And the bad ones will not even be alive to see the 6 losses. They would have lost everything they had by the 2nd or the 3rd loss. I now have some newbies here. I invited you for this webinar. So sorry, I'm being a little bit blunt, but I wish somebody told me this 7-8 years back. My trajectory could have been a little bit different. Now let's move to the next slide. So you have to know that no strategy wins all the time, whatever the name of the strategy, whatever you call the strategy, including the strategies we are going to teach you guys this week. We'll be looking at 4 different strategies this week. None of them win all of the time. You will win sometimes, and you will lose sometimes. So it's only logical for you to trade in such a way that when the losses come, you can absorb them and still be in the game for when the winners will eventually come. It's like the normal probability we do when we're in school. And you are asked that if you have 3 green balls and 3 red balls in a bag, and you shuffle them thoroughly, and then you pick one ball, what is the probability that it will be green? There is the probability that you pick greens or red. But if you continue to dip your hand into that same bag, very soon you pick an alternate color. If you trade in such a way that 2 or 3 losses will take you out of the business, when the winners come, you won't have money to catch them, and therefore your loss will be permanent. You can lose in such a way that your losses aren't permanent, they are transient. You are more likely to lose more times than you win. I think I've explained that. Hence, a gambler's mindset of winners take all will leave you broke. And this is a global, undisputed fact. If you trade in such a way that it's either I blow this account or I make it, you are using a gambler's mindset. It may work for you in the short run, but in the long run, you will eventually go broke. Because the market is designed in such a way that most strategies will lose more than they will win. You are more likely to go broke trading than you stand the chance of becoming rich. Why? Most of us are wired that way. We have FOMO, fear of missing out, fear of leaving money on the table, fear of losing, and so many other fears that we have that has pitched us against success in the market. And you need to unlearn those inherent attributes that makes us lose. You need to unlearn it. Unfortunately, we don't all learn at the same frequency. Some will accept the reality that I will blow some of my accounts some days, and then I'll make some money some others. And therefore, the losses wouldn't hurt them that much. Some will suck when they lose or when they lose, and it will have damaging effect on their psychology. This was one of the arguments we were having yesterday. Small money makes small money. So when in the Telegram group, some people were like, hey, you can fund your account with $1. You can, this broker allows you to fund with $10. What? What are you doing? $1, $10. Even if you quadruple your $10, what's it going to do for you? Remember the statistics. Those people who do quadruple, they don't last 3 weeks. They lose everything. The guys who have been there consistently for 8 months, they trade conservatively. And they are disciplined in the sense that once they hit a particular take profit or target, they don't trade again. They take a walk. They go refresh their mind. And they ensure that they risk a fixed amount on a daily basis. Nothing shifts that focus. So if there is volatility and they lose, they accept the loss and go home. They don't remain in there like we saw and then lose even more. We saw it in the data. The data said when the market is more volatile, more traders fail because of lack of risk management. And they said in the third point, if volatility is prolonged, it is a bloodbath of epic proportions. Why? Some people just don't know when to stop. They don't know when to quit. They are trying to fight a $7.8 trillion market with a $100 account. The motivational speaker that spoke to you must have done a very good job to make you feel you can surmount a $7.8 trillion account, a market with $100. Small money makes small money is a global law. It's one of the laws that Isaac Newton brought out. For every action, there is an equal and opposite reaction, guys. And this law is not going to change just because you are now involved. Who are you? Who am I? If you want to make money, you have to prepare to trade big money. You have to put yourself in such a way that you can trade big money. I appreciate the fact that if you have $5,000, you could put $100 into your account or $200 into your account, trade it. If it blows, you put another one. If it blows, but yeah, you can be profitable that way. That's another form of risk management. But that will not make you to trade big money. Nobody will give you an account or big money to trade if they know that your strategy is blow it all or make it. Then all of you go and bring money again. We'll try it again. Blow it all or make it. Nobody's going to give you money. One of my friends, he'll be coming up perhaps on Wednesday or Thursday to take us one of his strategy on AQZ. He's doing copy trading now somewhere, but nobody's going to follow him if they go to his results and they see that all he does is blow it now, put more money that will make it. If we make it, fine, you have money. Then we'll blow it again. Nobody's going to follow that kind of trader, right? And one way you can trade big money is do a copy trading like he's doing. So people all across the world copy you and pay you a certain commission. You are trading big money and then you become richer. The only way to become rich trading is by solving the trading problem of several other persons. Make money for others and then you make money. But don't go collect money from anybody, guys. To be able to manage your risks properly, I suggest, it's not a must, and I've not read it in any Forex book, but from my experience, I suggest you ensure you have an alternate source of income aside trading so that you are not under pressure to bend the market to your emotional and economic needs. The market owes you nothing, and the market doesn't know you exist. So how would we deal with our risk? If you remember the analysis we saw here, we can glean two things out of it. Number one, they have a fixed percentage they trade, fixed amount they are willing to risk per day. In this market, you cannot predict what you will make, but you can predict to a great level of accuracy what you are willing to lose. You can say, I will go in for 0.1, one standard lot trade on EU for 30 pips stop loss. Therefore, I'll be losing $3,000 or $300. You can do that. But you can't say for sure how much it will give you in return, except if you use fixed stops. That exit, that is both stop loss and take profit. So you notice one thing they did, they had fixed way of assessing their risk. And number two, they ensured that they were taking something out of the market. right? When they hit a particular percentage, they ensure that they take that money out. All of them make sure they get paid. Once they make that percentage, they put their hands in their pocket and staple the pocket and wait until they make money. So we're going to do the same thing. How do we position size? And I'm going to introduce us to a concept called twin trading. So number one, you must have a fixed risk or measured risk. And number two, you must find a way of taking something off of the table when the market offers it to you. The market is not a Father Christmas. Don't be a Father Christmas to the market. So how do we do this? Enough of the slides. Let's go real life now. There is a website called myfxbook.com/forex-calculator/position-size. Just simply type position size calculator. And there are apps you could use on mobile devices, Android to be specific. I don't know of iOS, but you find them. You can use these things to look at your risk. You must have a way of measuring your risk. And I'll suggest as a newbie trader, rather than bug yourself with a $1 account, $10 account, $100 account, try to clean and grow your skill on perhaps a demo account of 1,000 or 5,000. And once you've done that and you have developed some level of consistency, you could now use that $100. Taiwo, how much does it take to buy a rapid account now? $10,000 rapid account with my Forex funds. Anybody there? Any of the old guys that can give us an answer? I think it's $80-something.
It seems 99 or up to $100.
Fine. So that $100 you have, you can now use it to purchase a $10,000 rapid account. Rather than trying to double this account, if you make 5% on this 10,000, John, remain unmuted. Let's do this calculation together. If you have a $10,000 and you make 5% times 0.05, that's 500. How much will they give you in a rapid account? 12%, right? So they'll give you times 0.12. That's 60. So you have used your $100 to make $60. You've made a profit of $60 instead of trying to make $60 on your $100. And that will mean you are making 60%, which is a very Herculean tax. It means that if you make 10% on this, your 10,000, you would have made 120. And there are many other ways you can do it. Recently, I and the team, we've been looking for new prop firms that can allow us to start making money from day one. Why? We also use this data I shared with you in the slide, where we discovered that the number of people who remain consistent continues to decline as the months go by. Meaning many people are not as profitable as they try to make you feel. Don't trade small money. And if you are in the habit of, I want to trade small money so that I'll just quickly make money, and you'll be fostering a bad mental structure that will damage your trading career. Or well, if it's not a career, it will damage your trading, whatever it is, career or not. The career looks like an office stamp. So let's say we are going to start with a small account so that you can see the calculation I was doing yesterday for you guys on Telegram. If you have $100 account and you wish to risk, let me put 1,000. You have $1,000 account and you wish to risk 1% of that 1,000. And you are taking a trade on Euro USD that has 25 pips stop loss. If I click on calculate, it will tell me that you should use a lot size of 0.04. If you use a lot size of 0.04, you'll be controlling $4,000 worth of whatever, the units. However, what you will lose, should you lose the trade, will be $10. $10 is equivalent to 1% of your account. Now, I want you to see what will happen if I come here and take out 10 out of that account, out of that balance. Now the balance is now $100. If I click on calculate here, the lot size is 0. It means for a 25 pip stop loss, there is no lot size for you in the market for you to trade Euro USD. It doesn't make any logical sense for you to be trading $100 with a 25 pip stop loss on EU. I don't care what any other person is telling you. This is, I didn't write this program. This is it in front of you here. Except you don't want to risk 1%. So let's say, oh, 1% is too small for me. I want to risk 2. Oh, great. So you go for 2%. If you go for 2%, now it's telling you can risk 0.01. And I'm telling you that even at that 0.01, you are still not doing the proper risk management. Because this 0.01 here is actually an approximation. You can't trade with a 2% risk on a 25 pip stop loss on Euro USD. I'll prove it to you. If I change this and put 3% and I calculate, it's still giving me 0.01 again. So how can 3% and 2% be the same thing? It simply means that that 2% was actually an approximation for you to get 0.01. If your plan is that I want to risk 1% of my trade every time, and I know that if I take 10 trades, there's a tendency I will lose 6 and win 4. So I have to lose consecutively for 100 times for me to blow my account, even though that is what it looks like on paper. In real life, the 400 losing trades back to back, you would have blown the account, right? But let's say that is what you are saying. If you try to 0.01, if you try to 2%, it means you only go 50 times and then your account is gone. But what I see many people do is that they try this with 20% of their account. You are trading a $100 account with 0.08 lot size. You only need 5 losses. And it's very easy to have 5 losses in trading. Very easy. I mean, very easy to have 5 back-to-back losses. Your account is gone. And there's nobody you can arrest. So if you play with risk management, anybody playing with risk management will get broke. Anybody romancing risk management is prolonging the day of consistency in profitability in trading. The longer you wine and dine with poor risk management, the farther you are away from repairing your mind to become a profitable trader. Because you first have to undo the damage you've done to your psychology, then you now start learning the proper way to trade. And I tell you, it takes time. It doesn't work by watching one video or listening to one motivational speaker who tells you you can do everything. It doesn't work that way. If you want to know the proper risks, you need to have a system that tells you your risks. We saw with that broker, I said, all of them, all without exception, none of them risks more than 2% per day. So how will you do that? You come here and do that. I'm risking 2% per day. I have a $1,000 account. I'm going to take 0.8 lot size to trade this. Now, you traded 0.8 lot size on EU because EU had 25 pips stop loss. Does that mean the next time you're going to trade EU, you should also use 0.08 again? The answer is no. You have to consider, to make money trading Forex, crypto, and some other things, if you are trading futures, you consider size and distance. Those are the two things we consider. Size and distance. By size, we mean your lot. By distance, we mean number of pips or points, depending on what you're trading. I'll give you an example. Go to the chart. So I'm going to call up Euro USD right now. I'm going to go to H1. And let's say I'm taking a sell trade. I'm taking a sell trade. And I want to sell from here. From this point to that point, that green candle. When price came back to it, I'm planning to sell. If that is what I want to do, my stop loss is going to be 42 pips. Right? My stop loss for this particular trade is going to be 42 pips. And I'm still trading Euro USD. So I'll come back here. My stop loss is going to be 42 pips. I'm risking 2% of my 1,000. I'll calculate. For this particular trade, the lot size I should use is 0.05. If I lose, I will only have lost 2%, which is $20. If I come back the next day, and this time, this is where I want to sell from, this other green candle. Now my stop loss here is 46 pips, right? So I'll change, or let me even use, I want to use something smaller. Okay, let's use this. Say I want to sell from here. So my stop loss on this particular one is now 15 pips. So here I'll change this to 15. And I'll calculate. Now my lot size is 0.13. So for every single trade, my lot size changes. This notion of laziness, that you just pick a fixed lot size for everything you trade. The guys who have been making money for 8 months, they don't have that sickness with them. They've tried to overcome that laziness. This thing is going to take you only 30 seconds or 1 minute to do. Do it. Just copy what successful people do and hope to be successful. But by repeating what you have done since 1990 and up till now, after Habakkuk has lived and died, you are still repeating the same thing. You've not withdrawn money from any account. People are asking you all around, what are you doing? You say, I'm a trader. I'm a trader. I'm a trader. Your shoe don't chop for bottom. I'm a trader. I'm a trader. You've not withdrawn 1 kobo from any domiciliary account. And you are repeating the same thing. If you can't come to position size calculator and do this thing, you are not ready to be successful. Every successful person minimizes their risk. That is the only thing we have control over. We don't have control over how much the market will give us and when it will give us anything. The only thing we have control over, at least to 99% of the time, is what we are willing to sacrifice to the market for us to try our edge. That is the only thing we have control over. So any argument you are having anywhere because you don't want to succumb to the fact that your argument is wrong, bring your data to prove it. Bring your data. Now, you've traded Euro USD, 15 pips stop loss, 0.13. What if your very next trade is Euro GBP? What if your very next trade is Euro GBP? And coincidentally, it's also the same 15 pips. Can you see that the lot size has changed now to 0.11, no longer 0.13? Can you see that? So do you see that it becomes not logical if you just assume that, oh, because it's Euro GBP and they all have 15 pips. Let me just use the last lot size I used yesterday. Some people just wake up, if they wake up to the right-hand side of their bed, they'll use 0.05. If they wake up to the left-hand side of the bed, they use 0.1. And if they had a nightmare and they fell off the bed, they use 0.2. Oh, but that's not how to calculate lot sizes. That's not how to determine your risk. The side of your bed has nothing to do with your risk. This is where you come to determine it. Right? What if this thing was Euro MXN? Euro Mexican, whatever it is. Can you see that for MXN, even though I doubt if you have a 15p stop loss, but for the purpose of this illustration, it is telling you that you should use 2.67 lot size. If you use anything less than 2.67 lot size, you are under trading. You are not risking your 2% in full. If you use the same 0.11 lot size, you are under trading. Yes, some people give you a timetable of risk management. They'll say if you have between 100 to 200, use this lot size. If you have, and some people go ahead and use the same lot size for Euro USD, for gold. Somebody was mentioning gold yesterday. Gold of all pairs. And you know, we have so many people in the Forex market, they will tell you, gold is my preferred currency. Gold is my preferred. Well, let me show you what gold did to some people. Let me show you. Look at October and November here. What was the most traded pair? Gold. But it was not the most profitable for October. It changed in November. It was still the most traded. And it was the most profitable. And in this particular month, that it was the most traded and most profitable, we had only 0.2% people passing. It's not an issue of whether it is your favorite pair. It's are you making money out of it? Nobody dashes you money trading because you are trading one particular pair is your favorite. Are you making money? That is what matters. If Japanese yen, Nigerian naira is not your favorite pair, but you can make money out of it, oh boy, trade that one. It's not an issue of it's my favorite pair here. We didn't come to trading to have favorites. We came to trading to make money. And let's not be sentimental or emotional about this. If I go to gold, XAU USD, and you have a 25 pip stop loss, and you want to reach 2% of your account, and you have $1,000, if you calculate it, it's going to tell you that you should use 0.08. In fact, I think they've changed this thing now. Look at the lot size here. It has changed to 0.01, right, on gold. They've modified it. Because if I go back to Euro GBP, it changes back to 1. It changes back to 1 here. So when you say you want to trade gold, you have to remember that your lots here is divided by 0.001. Let me show you again. Gold, XAU USD. Look at the lot size here. Look at divided by that amount. Divided by that amount. In essence, even the $1,000 account, gold is seeming too big for you because you can't measure your risks effectively. Again, I mentioned from the very beginning, some people will feel offended, but this is just the truth. And I'd rather tell you the truth so that you start learning it the right way from now. Except if you feel you are better than the 6,900 and something people that we analyzed at the beginning of this class. Are you better than them? Didn't you go to the same school? Didn't you watch the same YouTube videos? Are we not all following the same mentors? Are we not all trading the same systems? What makes us think we are better than them? If 99.8% fail, shouldn't we rather ask, what did the 0.2% do? And let me copy that, rather than trying to force the habit of failures and convert it into success. No matter how you beat a leopard, it cannot change his spots. This is how you do position size. It means that you and I can be in the same signal group. They give us the same signal, but your account balance is bigger than mine. And when I come to do position size tells me, oh boy, you can't take this trade. There's no lot size for you in this trade. And the other person can take his trade, so he takes it. It doesn't mean because he's taking the trade, I must take the trade if our account balance is not the same. I can have a $100 account and say I want to trade gold. If I take this thing back to 1, so that I'll take it back to 1, so that I can just understand what I'm saying. It's 0 lots. 0 lots. 0 lots. All right. The next thing, the last thing we see here before we wrap up, we discussed the issue of twin trading. And twin trading is to help us do one of the things that these guys does. They ensure they get paid. We are using it to find a way of taking something off of the table when the market offers it to us. Many a times as traders, when we see the charts, we think it's going to continue to go up. So we take our trade from here. It goes up a little. It gives us some money. Then it comes down and takes us out, and we are sad. Then it goes up, and it looks like they are monitoring us. Nobody's monitoring you. It's because there's what they call the herd mentality. Most people think the same way. Most people think the same way. For you to be a profitable trader, you have to be crazy. You have to be a crazy person to be a profitable trader. In other words, you have to be thinking opposite of 99.8% of the people. Very opposite. Right? So you took a trade at 0.1, or rather, you took a trade at 0.1 here. It went to 0.2, then it came back and took your stop loss at 0.3, then push up to 0.4. You saw some money. You thought it was going to continue to go up. It came down and you lost all of that money, then even lost part of your equity before it finally goes in your direction. What can you do? What can you do to ensure that this thing, well, not to reduce the rate at which these things will happen? There are many ways you can do that. But one way we teach is twin trading. Twin trading. And by definition, twin trading is that you enter the same trade twice. That's what it means. So if you, let's go back to our initial analogy. Let's say you have a $100 account and you are risking you are risking 2% of your account for a 25 pips stop loss. And it's giving you 0.01 lot. How will you twin trade with a 0.01 lot? If you twin trade with a 0.01 lot, that is, you enter the trade twice, you are no longer risking 2% of your account. Now you are risking 4% of your account. You've broken your own rule. So for you to twin trade, your position sizing has to be at minimum 0.02. So I'll tell you what twin trading does now as we wrap up. Your plan is to enter a trade at point A. Your stop loss is somewhere here. You've done your position sizing, and your position sizing, let's just do that. Let's just find one to do. Sorry. Let's say you have a $1,000 account. Now it's telling you to use 0.08 lot size. Therefore, you decide to take your trade. You are hoping to go for a buy. Your entry is at point A, or let me just use E for entry. This is your entry. And you have a 25 pips stop loss. You have a 25 pips stop loss. And if you lose 25 pips, you will be losing $20. This is the lot size you've been told to trade with. So what we are proposing, is a proposal, is that you take two trades, trade 1 and trade 2. And each of them should have a 0.04 lot size. It is expected that every single one of us in this webinar understands and know that the best way to trade is that your risk-reward ratio should be asymmetric. If you don't understand risk-reward ratio, go to our YouTube channel, 7-Figure Possible, look for the beginners video. We have about 6 or 7 videos on beginners and watch them. We explained to some level what risk-reward ratio is. So we expect that your risk-reward should be asymmetrical, meaning that if you are risking $20, it should be because you stand a chance of making greater than $20. For ease of calculation, we will say it is because you are planning to make risk $20 for a possibility of making $60, or 1:3, something like that, or 1:2 for $40, something like that. So if you twin trade, you have a 25 pip stop loss. You could decide to do this. For trade 1, you take your profit at 25 pips. This is TP1. And for trade 2, you take your profit at 75 pips. That's TP2. So this is 1:1, and this is 1:3. Now let's do the calculation together. If you take the trade and both trade, let's look at the scenario. Scenario number 1, both loses. You lose both. If you take trade 1 and trade 2, you apply them. Trade 1 hits stop loss, trade 2 hits stop loss. How much will you lose? $20. You get that? You lose $20 because 0.04, 0.04 is equal to 0.08, which gives you a risk of $20. If both of them go straight and hit your stop loss upon entry, you lose $20. You have another scenario. 1 hits TP. 2 hits stop loss. So let's look at that. Number 1 goes and hits TP. If he hits TP, what will you make? You make $10 from that one, right? Total would have been $20 if it came down 25 pips. So each one is $10. So when this one gets here, it gives you $10. Number 2 will also be at this point to give you $10. But because you have placed your TP here, this $10 will close automatically. You still have $10 floating, hoping that the $10 will come to TP3. But somewhere along the line, remember that analogy we gave? You entered the trade, it went up your way a little, then came back. So the trade went back and hit your stop loss. So what happens at that point? You would have lost $10, and then you also have made $10. Your profit is going to be what? $0. Right? Scenario number 3. 1 hits TP, and 2 hits TP. So number 1 goes and hits your TP1, you make $10. Number 2 also goes and hits your TP3, you make how much? $30. In total, you come out with $40. So the only time you will lose is when it goes straight up to hit your stop loss, and there is nothing you could have done about it. If you knew you were going to hit your stop loss, you wouldn't have entered the trade ab initio. So aside losing, you've put yourself in a situation where you either break even and therefore you don't get to lose anything, or you actually win all of it. There is a 4th scenario which I wouldn't suggest you do, except if your backtest data supports it. The 4th scenario is that first one hits TP, and then you break even as soon as that happens. And let me explain what that means. It means that you entered a trade. Once this one hits TP, this stop loss that is here, you will modify your trade and take the stop loss and put it back at your entry, so that this second trade has only 2 things to do. It's either it goes up to hit your TP, or it comes back here and it closes at 0 profit. And that way, you would have made only 25. If you do that, right, it means that you are risking, if it comes back to hit your entry, it means you are risking $20 for a possibility of making $10. Your risk-reward ratio becomes asymmetric to the negative side. It means you are risking more than you are planning to win. So we try to avoid that situation. This is one way you can ensure you take money off the table if you are not trading for a prop firm. If you are trading your personal account, I would suggest you adopt. Like I said, there are several other methods, but this is one that is easy for us to follow. If you don't know how to in trade, it's very simple. Enter 2 trades. You'll have the same entry, the same stop loss, but different take profits. So I'll be stopping this recording from here, and I'll give room for 1 or 2 questions, and I'll call it a wrap. We'll be meeting again 8 p.m. tomorrow as we take on our very first strategy. Hopeful that we've been able to share some knowledge here today.